Hello, everyone. This is Dan Veru from Palisade Capital Management. On behalf of everyone at the firm, we hope that you had a wonderful holiday season and we wish you the best in the new year. In the next few minutes, I'm going to briefly review 2022 and then discuss the road ahead for 2023. 2022 was the worst year for stocks and bonds since the financial crisis of 2008. For more than a decade, central banks around the world kept interest rates at or near zero and negative when factoring in inflation. 2022 marked a stark about-face as most central banks, led by the Federal Reserve, aggressively raised interest rates to combat 40-year high inflation caused by monetary and fiscal spending. The Fed funds rate, or the rate banks charge each other, is set by the Federal Reserve. It started 2022 at 0.25%, and by the end of the year, the rate was 4.25%. Truly a historic move in a relatively short period of time. Chair Powell has made it very clear that the top priority of the Federal Reserve is to tackle inflation and bring it down closer to its target rate of 2%. Unfortunately, the only tool it has is aggressively raising interest rates. This has caused broad weakness for equities, but has hurt highly valued aggressive growth stocks and technology leaders more, while lower multiple value stocks did relatively better. All sectors were negative for the year with the exception of the energy sector. Stocks have had down periods in the past, but the sell-off for bonds is of a magnitude that has not been seen for at least 40 years. 2022 will go down as a paradigm shift for investors, from lower for longer to higher for longer on interest rates. The Fed acting as a backstop for investors by flooding financial markets with capital is over, as the Fed moves towards normalizing the environment for interest rates and getting inflation under control. For the road ahead in 2023, we do not think that the stock market has bottomed out. Interest rates have also not peaked yet, and we don't think that economic activity is likely going to accelerate. We do think that inflation has very likely peaked and will drop over the course of the year. I'm actually optimistic, even though those sound like dire conditions for stocks. We're very constructive on security selection when looking at either stocks or bonds, because an active approach can deliver better returns than that of the indexes and ETFs. For stocks, success is going to occur only through intense bottom-up security selection of very well-managed companies with specific financial characteristics that address segments of the economy that can still grow despite a slower macro environment. The financial characteristics of companies we think will do best are companies that have strong free cash flow, have a reasonable price earnings multiple, and have moderate growth prospects. The companies also should have a modest amount of debt on the balance sheet, because raising new capital today could be quite expensive, especially if a company has to borrow money. From a sector point of view, we think that industrials, materials, and financials are well positioned. Industrials and materials companies could benefit from the 3 recently passed spending bills by Congress, which exceed $2 trillion of mostly infrastructure type spending. Financials, like banks, are well capitalized and benefit from a rising interest rate environment. Healthcare and consumer staples companies are also sectors that can do well in a slowing macro environment. We still like technology, but we're staying away from the mega cap growth stocks in favor of data services companies and applied technology, hardware and software companies. The previous technology winners have done poorly in 2022, but they're still quite expensive and probably have more downside. Also, previous open-ended sectors of technology like cloud services are beginning to slow. For bond investors, credit quality and security selection is perhaps more important today than ever before. With interest rates rising and a shaky landscape for the economy, it's important to pay attention to the maturities of the bonds. Duration, or a bond's sensitivity to changes in interest rates, is important for a manager to consider. Generally speaking, maturities of around 5 years optimizes and balances the risk reward. In conclusion, we've just finished a year with a lot of changes. We have a war between Russia and the Ukraine, a spike in receding prices of oil, a string of significant interest rate increases, inflationary pressures, and a resurgence of COVID-19 infections in China. The midterm elections are over, and we have divided government, which could slow or change the president's agenda. Supply chains, while improving, are still stressed. On the other hand, there are more attractively priced stocks today than we have had in a very long time. Bond yields have also come up to levels that are much more attractive today than they were even just a year ago. It's going to take discipline, patience, and hard work in order to outperform. A passive approach to investing, in our opinion, is not going to deliver the best returns. As always, we'll do our best to uncover investment opportunities with the best risk-reward characteristics. Again, thank you for your support during 2022, and we look forward to speaking with you often over the course of 2023. Thank you.
The information contained in this webcast reflects the views of Palisade Capital Management, LLC, as of the date of its original broadcast, and such views are subject to change without notice at any time. All information provided in this webcast is for informational purposes only and should not be considered investment advice or recommendation to purchase or sell any specific security. While the information presented herein, including information obtained from third parties, is believed to be reliable, no warranty is made concerning the accuracy of such information. There can be no guarantee that any forecast discussed in this webcast will be realized. Consult your financial advisor before making any financial planning or investment decisions. Past performance is not a guarantee of future results.